Hi, everyone. This is Matt DeLorenzo with United Asset Strategies, and welcome to our January investment webinar. As usual, I'm joined by Tom Healy and Jiorden Sanchez. We're here to take you through some key points and slides from our Q1 investment letter to clients, covering our thoughts on policy as well as markets. So to get us started, I'll turn it right over to Jiorden for a recap of Q4 2025.
Thanks, Matt. Last year was another reminder that markets often climb a wall of worry. As you can see in Exhibit 1, despite a tariff-driven drawdown early in the year, the S&P 500 still finished up about 18%, marking the third straight year of returns in excess of 15%. While policy uncertainty held back the broader market participation many expected, this was more than offset by optimism around AI. With the Grade 8, the Magnificent 7 plus Broadcom continuing to lead markets higher. Fixed income also had a solid year as rates moved lower, with the Bloomberg Ag returning over 7%. Now, with markets sitting near all-time highs, it's natural that some have begun to worry about a pullback. But as shown in Exhibit 2, history often tells a different story, with market highs often leading to new highs. Our outlook is a bit more nuanced. With valuations and market concentration stretched, future returns will increasingly depend on earnings growth beyond the Grade 8. And while we remain cautiously optimistic for reasons we will discuss later, there will always be risks to monitor and manage. So we'll close out our discussion today by walking through our approach to thoughtfully diversifying client portfolios in this increasingly concentrated market. But first, I'll turn it over to Tom to provide an update on the economic and political backdrop we're investing in.
Thank you, Jiorden. One of the real drivers of the market last year was a resilient U.S. economy. As you know, despite the uncertainty around trade policy, the last few quarters saw increasing GDP growth. We anticipate that's going to continue in 2026. What really kept the economy afloat was the strength of the consumer, but also corporate spending related to AI. As we look towards 2026, one of the concerns is the labor market. It has softened, but what we look at here in Exhibit 3 is the number of job openings has come down at the same time the number of unemployed has come up, but they've actually met. So they're actually equal right now, which kind of gives us a sense that the overall labor market, while softer than it had been, is really in equilibrium. And so that's important going forward for the consumer, as is the fact that we're going to get a substantial fiscal tailwind in 2026 from the One Big Beautiful Bill Act. Things like individual tax rates are down, corporate tax benefits, the Federal Reserve balance sheet unwinding, and then also deregulation in the financial markets all lead to what some estimate to be about a $700 billion fiscal tailwind. So that should keep the consumer and therefore GDP growth stronger into 2026, which is the midterm year, and which is typically the year in the 4-year presidential cycle where GDP is the highest. So we would anticipate that's going to hold true as well this year. But what's important is that really hasn't translated into market gains. So if you look at Exhibit 5, what you see there is in the first year of a presidential term, which was last year, the market actually was almost exactly the same as the historical average, with more volatility you can see in the darker green line. But when you look to year 2, it's the 1 year of the 4 years of a presidential term that's actually down for part of the year. And going into the election, we tend to see a choppy market. Then after the election's over and we lose that uncertainty, then we see markets move higher again. So we would anticipate this year from a policy perspective to be a tailwind for the consumer, but also for being choppy related to election uncertainty. The other key part of this is going to be monetary policy. And for that, I'm going to turn it over to Matt.
Thank you, Tom. Yeah, in the bigger picture, I'd summarize it as the second half of 2025 really brought notably more accommodative monetary policy situation. There's two things that were really driving that. So the first, after holding for really the first half of the year, the Fed began to cut rates and actually cut rates 3 times in the second half. So that brought the Fed funds rate down by 75 basis points. But the other thing that we also wanted to bring your attention to is really summarized here on the chart on the left. And this is the Fed's balance sheet. So it's really their holdings of treasuries and mortgages. So you can see in the middle of the chart, when the line really starts to spike up, that was the Fed's response to COVID. And it really, to help with issues that were going on with the markets and fear of the economy. That was a way, in addition to rate cuts, that they were supporting the economy, buying mortgages, treasuries, and trying to drive interest rates down. What you'll notice, though, in the chart is that since 2022, they began to unwind some of that portfolio. So they were actually reducing the holdings on their balance sheet. And according to some of the Fed's own research, that is estimated to have had the effect of about 2 additional rate hikes. So a little bit less accommodative throughout that period. But really what's happened in 2025 is the Fed announced that they would stop shrinking the balance sheet and move towards more of a policy of maintaining it. So that stealth tightening really going away, combined with the three Fed rate cuts, really kind of changed the stance of monetary policy going into this year. If we move over to the chart on the right, we bring your attention to this for a couple of reasons. The first is that it really correlates to one of the trades that we've had on in a lot of our client portfolios, which are yield curve steepener bonds. And this is a chart of the yield curve. So what it's showing you when it's green on this chart is basically long-term yields are higher than short-term yields. And when it's yellow towards the bottom, it's really inverted, meaning that short-term yields are higher than long. And what we've seen with the Fed cutting rates and some term premium coming back into the longer part of the bond market is we've moved to a more normal yield curve where we're getting more compensation for longer term bonds. So this has helped our yield curve steepener positions. You may notice that these are some of the better performers within bond portfolios in 2025. But the other thing is we've been using this as one of our cues to extend duration a bit within our bond portfolios. And basically, one of the reasons is that simply there's more carry in the longer bonds, and our investors are getting compensated in more yield for extending duration a bit. So that's just one of the things going on within our bond portfolios. Obviously, there's a lot, and that there's always things going on under the surface. But similarly, for a look under the hood on the equity side of things, I'll turn it back over to Jiorden.
Thanks, Matt. 3 years into the bull market, the S&P 500 is up 80% and has less headroom on valuation multiples and market concentration as a result. To that end, the index trades at 22 times earnings, with the grade 8 approaching 40% of total market value. Both are high by historical standards. As a result, the next phase of the bull market will depend more on earnings growth, particularly outside the grade 8. So as shown in Exhibit 6, fundamentals at megacap tech have carried the market over the past 3 years, with earnings growth from the grade 8 contributing to nearly 10 percentage points of the market's 22% annualized return. Multiple expansion added another 8 percentage points. By comparison, just 4 percentage points came from earnings growth among the remaining 490 plus companies, many of which lacked AI tailwinds and faced higher costs from rates and inflation. Encouragingly, the street expects a resilient economic backdrop and policy tailwinds to support broader growth from here. So looking back at Exhibit 6, you can see that the remaining 490 plus stocks should contribute a more meaningful 8 of the 15% earnings growth expected for the market in 2026. While we remain cautiously optimistic, diversification has become increasingly important in this highly concentrated market. As noted earlier in our last webinar, we don't believe today's AI-driven market is in the dot-com bubble territory we saw in the early 2000s. Today's big tech are higher quality and not as pricey. That said, the market does appear highly levered to the AI theme. One way to see this is in Exhibit 7, which breaks out market exposure by its correlation to semiconductor and AI ETFs. It shows that nearly 50% of the index is highly correlated to the AI theme. Further, when you factor in the higher beta of that exposure, AI represents 2/3 of market volatility. While optimistic on AI, it wouldn't surprise us to see this multi-year tailwind experience a few air pockets along the way. As a result, we continue to favor diversified portfolios less reliant on a single theme, especially as opportunities outside the grade 8 improve. To close, Exhibit 7 also highlights areas of the market with low correlation to AI. This represents hunting ground for complementary investments that may hold up better if AI leadership falters. So with that, I'll turn it back to Tom for a brief word on financial planning before closing us out.
Thank you, Jiorden. So as you can see, the team is going to continue to parse through a substantial amount of data as we manage portfolios for clients here in 2026. One thing I'd point you to, as Jiorden just alluded to, is that the last part of our letter discusses changes in tax and retirement planning that's coming as part of the different acts that have been passed. Things like retirement contributions, new Roth catch-up contribution requirements. That's all detailed in the letter. But for further information, feel free to contact your advisor who can walk you through these changes. With that, we thank you for your time and attention, and we look forward to catching up again next quarter.